I'm pleased to welcome my first guest today, David Breach, who is President and Chief Operating Officer at Vista Equity Partners. Thanks for being here at Connect and here in Arizona. And I know you had a wonderful discussion with our CEO earlier, but I would love to hear more about Vista Equity Partners. I know it's your 25th year anniversary. You've been there for quite a while as well. So tell us about the mission of the company, the focus, what differentiates you.
So Vista was founded by Robert Smith 25 years ago. His focus was really enterprise software, business-to-business software. He saw the business model and thought it was a fantastic type of business to invest in. And his belief was that if you brought a systematic approach to operational transformation, that you could create value for your investors on a very consistent and repeatable and predictable basis. And as you look at Vista today, now being a $100 billion plus asset manager, we currently own 90 companies, about 125,000 global employees across our portfolio. But we remain very keenly focused on the opportunities in the enterprise software space.
So specifically focused on that industry vertical, and I guess the question is why? You know, if I'm an investor and I can have all kinds of diversification in my portfolio, you know, why is focusing on that software niche really beneficial?
Yeah, so what's interesting, so software is the largest part of the global economy, and it's continuing to grow at a 17 to 18% annual compounded annual growth rate. So it's a very large industry that is continuing to get larger. The other thing that's very interesting when you talk about diversification is that when you invest in software, you end up in a highly diversified portfolio. So our companies serve almost every element of the global economy. So there's a natural form of diversification. And the typical company that we want to buy is a company that, you know, in general has 90+% of its revenue is recurring revenue. It tends to have retention rates above 100%. So these are highly resilient businesses. And these are businesses that tend to operate at very high gross margins. We talk about a rule of 40 where we look at the top line growth rate of the company and then its underlying profitability, and those should at least equal 40 when you add them up. So if you're a 10% growth oriented business, you should probably be making 30-35% EBITDA margins on the business. So these are businesses that when run well generate lots of free cash flow and are highly resilient businesses.
Right. And what's interesting about that, David, is with the rule of 40 that you bring up, when you look at the public market software universe, there's actually surprisingly not that many companies that meet that rule of 40. And you know, when I look at the earnings growth for that publicly traded software space, it seems like, you know, it really peaked during COVID. It really tapered off, and maybe we're at an inflection point. But I guess my question is, you know, why now? Does software make sense not only from this long-term secular perspective, but is there also an attractive entry point into it now?
It became apparent pretty quickly that software was going to help companies adapt to this new world, and they needed to be closer to their customers from a digital perspective. They needed to digitize their supply chains. They needed to have different levels of connectivity with their employee base. So you saw this pull forward of some software consumption during COVID, and the markets really got very focused on growth, and you saw enterprise software multiples peak at a little over 17 times forward revenue, which, you know, for us that have been doing this for a long time, we just thought were crazy multiples. Yeah. Well, you got to 22 and you saw a complete reset, right? People were like, growth at all cost is gone. We talk about 2022 as almost a tech wreck. And you saw all these growth-oriented companies that had started to slow their growth get crushed in the public markets. And so in, you know, kind of 22, 23, we saw a lot of opportunity in the public markets to buy great companies and take them private and really make operational transformation in a private context, which is oftentimes easier to do. As you look at where we are in 25, you've really seen the private markets reset their valuations to what we would consider more normalized, you know, 6 to 8 times, 6 to 9 times revenue multiples. The other interesting thing about software is 96% of the companies are private. So if you want to invest broadly in software, it's really hard to do it only in the public markets. So we think there's fantastic opportunity in the private markets right now. We're very excited about it.
We also should talk about generative AI.
Yeah.
And I know you think of it as a huge commercial opportunity, but you think of it in terms of 3 waves. What are they? Which one are we in now?
So as we think about the overall adoption of generative AI, wave one is about the semiconductor waves, building out some of the fundamental chip technology to enable generative AI. We really view wave two as being the build out of the infrastructure. So whether it's the data centers, the capacity, the compute capacity within the hyperscalers. But we really think the third wave is really the most exciting and the longest tail, which is taking this technology to either enhance the products that you have or build new products and new vertical applications to utilize this technology for customers. And so we are very focused on how our companies can leverage generative AI, and we really see it in kind of three different vectors. One is making an enterprise software company operate more efficiently. So we have companies that have maintained fairly large customer support functions that are finding through generative AI solutions that they can deflect 30, 40, 50% of these customer support calls to a generative AI agent. And we're saving the cost of needing those people to provide this support, but the actual customer satisfaction scores are going up. So that's kind of one element of the Gen AI story for software. But then I think the two even more important elements on Gen AI are, one, how are we enhancing our products to make them more valuable, more insightful, to create solutions that expand the TAM for our business. And then as you move into the agentification of our software solutions, we think that expands massively the TAM of a number of our companies and creates, frankly, new pricing dynamics.
Right. I mean, when you think about artificial intelligence, it's a huge shortcut to productivity. And when you think about, you mentioned TAM and the total addressable market of AI, 80% of it is software.
Yeah.
So an incredible opportunity indeed. And you obviously focus on equity investments in software companies, but you also have a very interesting private credit business, FounderDirect. So what is that? Give us a bit of a flavor for what kind of lending you do there.
The concise version of that is we've been able to leverage the Vista ecosystem. So we have over 220 investors that spend all day, every day meeting with oftentimes founders of great software businesses, seeing if they're open to being acquired. Many of these companies are not ready to be acquired, but they have capital needs. And so we can then, frankly, refer them to our credit business to provide a capital solution that is less dilutive than growth equity and provides the differentiation of someone who does nothing but lend into enterprise software businesses. So we call this FounderDirect because we're lending directly into, most cases, these founder-run businesses. And what differentiates us versus others in the private credit space is most private credit is really serving financial sponsors like us in terms of LBO financing. And there tends to be a fairly high correlation between the different private lenders. When we do a large transaction, the 5 or 6 or 7 largest private lenders, private credit providers are all in the same credit with us. This is a highly diversified and differentiated source, and because we have this capacity by bringing all these investors throughout the software ecosystem, we're able to source credit in a very differentiated way, where we get better covenants. We're oftentimes getting warrant coverage. So, we would never give warrants to a private lender in a normal LBO financing, but in these founder transactions, because of the value we're going to bring to them, we're oftentimes getting warrants in these transactions. So we think we're able to create some additional alpha without taking on any increased risk.
Thank you so much, David, for the conversation today. It's been really terrific to hear about the 25 years of history and the tremendous opportunity helping investors access, which, my takeaway is that it feels like it's always a great time to be looking at software, but especially now there's quite an attractive entry point, and there's a couple of ways to do it in equity as well as credit. So thanks so much for your time today.
Thank you very much, and you guys are putting on a fantastic conference. I'm happy to be here.
Thank you.